The Israeli currency, the shekel, continued weakening on Wednesday, and shares on the Tel Aviv Stock Exchange also plunged further. That's as a credit rating agency Fitch put its A-plus sovereign credit score on Rating Watch negative. The agency has warned of increased risk of a large-scale military conflict if Hezbollah and Iran were to join the fighting. The shekel this week crossed the 4 per dollar threshold for the first time since 2015 as Israel declared war on Hamas, with traders increasing their short bets against the currency, in turn putting pressure on the Bank of Israel to essentially keep interest rates on hold and stabilize the currency. The shekel has fallen almost 5%, and the country's stock exchange is now down 7.5% since the beginning of the conflict. Let's get more now with Susanna Streeter. She is Head of Money and Markets at Hargreaves Lansdown. Thank you very much for being with us today on the show and helping us understand a little bit more on what's happening. Susanna, so we know that the Bank of Israel has pledged to intervene with a vast amount of money to contain a potential currency depreciation there in Israel. We will see consequences not just in Israel, but for the whole region. But for what concerns Israel first, how has the currency behaved so far, in your opinion? Do we know if and to what extent the bank will intervene?
Well, yes, we've already heard from the bank that it's willing to intervene to the tune of 30 billion, to sell up to $30 billion worth of foreign exchange to support the currency. However, we have, although we saw a slight uplift after that assessment was made, we have since seen the currency fall back even further. And this was after, of course, this negative watch rating placed on Israel, which is, of course, pretty understandable given the scale of the issue that Israel is currently facing, the possibility that the conflict could widen and encompass other countries in the region. That's why this a negative watch has been placed, but we don't know yet whether or not the ratings agency will follow through with the downgrading, because of course it's all going to really depend on what happens next. Can this conflict be contained? And if it does so, I think it's likely that the credit rating will stay in a similar position, because of course Israel has dealt with events like this before, perhaps not quite of this magnitude, but certainly that's what the ratings agency assessment is.
And Susanna, if this were to become a large-scale military conflict, what are the potential economic consequences, not just for Israel, but the whole region as well? I mean, do you see oil and gas prices shooting up? What would be the emergency there?
Yes, we've already seen that to some extent. The price of oil creeping up has dipped back a little bit in trading today, but certainly there is concern about how supplies could be affected if there is an escalation of this conflict. In addition, there would be an expectation of additional military spending, destruction of infrastructure, and also real change to consumer and investor sentiment right across the region. So that, of course, would have implications for not just Israel, but other economies as well. I think we should remember the state of Palestine's very, very poor economic situation before all of this began, with more than 60% of citizens refugees, those people living in the country, and many at the poverty line, more than 60%. So, of course, it's not just the focus has to be right across the region, but it's interesting, of course, the credit watch change today for Israel.